todos bien y que os resulte atractiva esta sesión que hemos planificado para hoy viernes en este campo. Seguiremos haciendo sesiones de estas y las transmitiremos adecuadamente en los próximos días. I'm going to change to English, to switch to English, because we have several attendees in English. This is important to make this like all we had done with the Energy Agency in the last 5 years. Well, this oil markets is the sixth conference, sixth seminar we are organizing in this area, in this COVID-19. The two first were related with the electrical system and electrical market. The third and fourth were related to the natural gas, and now we are this week organizing two related to oil system and oil markets. Today is with oil market, as I told before our speakers. This is a market on fire. Several news in the newspapers, on TV, broadcasting all about them, and they are very good speakers for this. We have these two speakers, Neil Atkinson. This is the 5th time he is coming here from the very beginning. He started in 2016 in the International Energy Agency. He has come here to Madrid to present the oil report for many years. Now we have here Neil to talk about the oil market today in this April. Maybe next month or the following month we will have here again to explain more about the report. Neil Atkinson is a very well-known here specialist. He is the head of oil industry and market division in the International Energy since 2016. Before, he worked in PDVSA for many years. That's why he understands good Spanish, and he worked for several communication branches like Plat or other parts. He is a good contributor in many TV shows and in many radio stations, as you can see after this. And we have another Spanish very well known for all of you, because more of you are Spanish nationals. Antonio Merino, Antonio Merino, chief economist of Repsol. I think he prefers this name, chief economist. He's an economist by training, by background in Spain and Madrid. He is a civil servant too. He was involved in many areas of the administration before he joined in 2000 Repsol. And he's a good contributor with us, no? Because he teaches with us several times. He always contributes when we ask him about participating in this relationship. Well, thank you very much, both of you, for that. As all of you know, maybe the system for this, they are going to make some presentations, starting by Neil, and after this you can send that through that. You can send your questions to them. You can use the chat, the open chat, or you can choose the private chat, sending to Pablo de Juan. Pablo de Juan, you know, is the technical officer here in the Spanish Energy Club. You can ask both whatever you want, and we translate then this question after this. We are beginning with Neil. Neil, it's your time and your floor. Please, whatever you want.
Thank you very much, and it's a great pleasure to be able to talk to the Spanish Energy Club once again. As Arcadio said, I've visited on several previous occasions. I always like to get to Madrid in the spring, hopefully to coincide with the Champions League round of 16 or the quarterfinals, but this year, sadly, that's not to be. So I'm going to talk in the next 20 minutes or so about the current state of the oil market. Just over a week ago now, the IEA published the April edition of its oil market report. And there's no doubt whatsoever that in the 36-year history of the IEA oil market report, this one was probably one of the most extraordinary we've ever published. And of course, many of you fully understand the reasons why. So I'll get into the meat of the presentation straight away. And the first slide that I hope you can see up on the screen here, Brent and WTI crude futures. Oil prices we've shown for about the last 6 months on this chart, and for the greater part of the end of 2019 into the early part of 2020, Brent and WTI prices were relatively stable. They were sort of trundling along in the just above or below $60 a barrel. We had a little bit of an upward movement at the start of the year when, as you may recall, the tension between the United States and Iran boiled over into Iraq. But since then, of course, the coronavirus crisis has taken hold. And as the extent of the crisis has become apparent, and those of us in Europe here, I live in Paris, and of course, most of you are in Spain, and back in my own country in the UK, we've seen the impact affect our daily lives, and it's had a huge impact on mobility. And prices recently have begun to reflect the overwhelming surplus of supply over demand in the oil market. And at the beginning of this week, as you will have seen from the press, the expiry of the May WTI contract led to a short period of negative oil prices where people who were obliged to take receipt of oil when the contract expired had no place to put it. So they had to pay somebody else to take it off their hands, thus negative prices. Looking forward on the right-hand side of this pair of charts, the market is in a very steep contango, meaning that today's depressed prices reflect the huge surpluses in the market we currently see, on the expectation that the surpluses begin to clear and demand does begin to recover later in the year, and we'll discuss that in a few moments. The prices are expected to be higher, but there's an awful lot that can happen, of course, between now and the later months of the year to prove this current outlook to be wrong or otherwise. So let's get straight into the demand side of the presentation. But the first thing to put up is the extraordinary graph we have here, which shows that as of today, about 4 billion people around the world are living under some form of containment or lockdown, as it's also called. Obviously, the lockdown and containment varies in its strength from country to country, but roughly today, 4 billion people are having to stay at home all of the time or for most of the time. And that, of course, has had a direct impact on oil demand, particularly in relation to transport fuels, which I'll show you separately in a second. The chart that's on the screen right now shows you the total oil demand growth pattern year on year for the months of 2020. The gray line that you can see represents the change in total oil demand. And currently we're in the month of April, and our executive director called April Black April because the decline in year-on-year demand is very close to 30 million barrels per day. And next month of May, we still expect an extremely weak demand month where the growth will again be over 25 million barrels a day, or the lack of growth, I should say, the decline. For 2020, each month of the year should see oil demand lower than the same month of the previous year, although in the second half, as we move through it, the performance does begin to improve to some extent. But for every single month in 2020, oil demand will be below the level of the year before. And in 2020 as a whole, we think that global oil demand will fall by just over 9 million barrels a day versus 2019, and that the volume of demand in 2020 will be roughly back to where we were in 2012. So essentially all of the growth that we have seen in most of the last decade is essentially wiped out by the extraordinary year we're seeing in 2020. Looking specifically at the products as far as the situation in 2020 is concerned, we've separated out here the transport fuels because that is the main or where the main impact is seen. And transport constitutes something like 65% or so of total global oil demand. And as you can see from this chart, the most heavily affected sector is jet fuel, the aviation industry. As you know, most of the world's aircraft fleet has been grounded. Air traffic has ground to a halt in pretty well every major market around the world, and it's jet kero, which is the yellow or gold, whichever way you see it, column here, that has gone down like a stone during this first half of 2020. And as we move through the second half of the year, jet kero remains the most affected of the major transport fuels. We have made an assumption that there will not be an immediate rush back to the skies, partly because governments may not allow airlines to resume their normal schedules. They may still be wary of the virus spreading. So in the second half of the year, jet kero remains weak. Diesel and gasoline, however, do fare better on the assumption that the lockdown and containment measures are eased in the second half of the year. And that is a big assumption that we have made. We do see people being able to take to the streets in their cars. Freight traffic will continue to improve, whether that be trucking or other forms of freight. And we should see diesel and gasoline perform relatively better. Fuel oil, particularly used, of course, in the maritime sector of transport, that has been hit by the reduction in global trade. But again, we think that as the second half progresses, we should see an improved performance for the maritime sector. But the main message here is that jet fuel has been hammered most of all by the impact of the lockdown measures, and we think it will recover only very gradually in the second half of the year. But we must emphasize that the outlook we're presenting for demand is based on an assumption that containment measures are eased in the second half. We have made no assumption of a return to, or rather of a second wave of the coronavirus. That is often talked about in the press and in the media, as you would have seen. But at the moment, our knowledge of the virus is not sufficiently advanced as to be clear that there could be a second wave. It is perhaps a possibility. And if it does become, on the basis of evidence, more likely there could be a second wave or a slower recovery in the second half of 2020, then we'll adjust our numbers accordingly. But for the time being, we have, if we just go back to the previous slide, whether you would describe this as a V or a U shape, it's a little difficult to be absolutely clear from the pattern of the numbers. It's, shall we say, a slowish V-shaped recovery. And we'll wait and see as new data comes in as to whether that is accurate or not. So that's what we're saying in summary on the demand side of the balance for now. The other side, of course, of the extraordinary situation we're in today is supply. And there are two aspects to this. On the left-hand side of the chart that you can see, we show the expected production cuts from the OPEC plus countries, this deal which was agreed probably nearly a couple of weeks ago now, which takes effect on the 1st of May, at the end of next week. There is some talk that the producers may decide to cut production ahead of that time, make an early start on the OPEC plus agreement because, of course, of the very weak market outlook. But it remains to be seen what impact an earlier start might really have. But the main point here is that in May, production is due to fall by 9.7 million barrels a day under the terms of the OPEC plus deal. That is, production must fall by production should fall to 9.7 million barrels a day below an agreed baseline. Now, in reality, the production in April was relatively high. So for production to fall to 9.7 million barrels a day below the baseline, the production actually has to fall to close to 11 million barrels a day to get to the agreed level. So there's a lot of work for the producers to do, and we must wait and see, of course, how well complied with this deal is, and we'll have an indication of that as we move through the month of May, and the export data the seaborne export data starts to become available. But as you can see from the chart on the left-hand side, there's an initial production cut agreed of 9.7 million barrels a day. On the assumption, the same assumption that we have made in our demand analysis, the production cuts are tapered down in the second half of 2020. And then from the beginning of 2021 onwards, the agreed production cuts are further tapered down and then all the way through into 2022. So that's the agreement. Now, on the right-hand side of this pair of charts, we are looking at the global picture by adding in, obviously, major producers such as the United States and Canada and other non-OPEC countries which are not included in the deal. And what we see here is that actually in April, production overall did actually increase. However, in May, in addition to the expected cuts from the OPEC Plus agreement, and and based on our assumption of falls in production from the United States and Canada and other countries, we see that in May versus April, global production should fall by about 12 million barrels per day. We'll wait and see if that estimate is accurate or not. By the end of 2020, we think that the production will be roughly 10 million barrels a day or so below the April level. And again, there's a lot of uncertainty concerning this because there is not as such a formal production cut agreement from, for example, the United States, which obviously has a very different energy governance structure than you see in the OPEC countries. But actually moving on to the non-OPEC countries, we had expected pre-coronavirus that in 2020 production would actually increase by over 2 million barrels per day by the non-OPEC countries, with the United States contributing just over half of that. Now, because of the impact of low prices and the impact of any agreed cuts that we might be seeing from some non-OPEC countries, the OPEC, non-OPEC production, I should say, is going to fall by very close to 2.5 million barrels a day in 2020. That's for the year as a whole. But by the end of the year, we think that the declines may well be as much as 5 million barrels per day. Again, because of the ever-moving oil market landscape and the fact that oil prices have fallen to even lower levels than when we actually prepared these numbers, it may well be that the impact of on non-OPEC production could be even greater than we currently show. That's something that we have to wait and see. As far as the United States is concerned, we are actually looking at a situation where certain authorities, such as the Texas Railroad Commission, and authorities in states such as Oklahoma and North Dakota, which are important oil-producing regions in the US, there is the possibility of regulatory cuts being introduced in those regions. We don't yet know if that will be the case. If it is, that is one thing. On the other hand, of course, the United States sector in particular has a very large number of independent companies operating there, as well, of course, as several of the major companies, Chevron, BP, ExxonMobil, for example. And the individual circumstances of those companies with relation to their shale oil production interests vary enormously, and we can't be sure exactly what the profile of their production will be as they seek to respond to lower prices. There's a lot of uncertainty there, but certainly at the current price levels we see for WTI, which I think this morning is about $16 a barrel, it is very difficult to see anything other than significant falls in non-OPEC supply in the US, and also in Canada and other countries that live within the non-OPEC family. Now, it's not just the impact on global oil demand, which is extraordinary, as we saw earlier, very close to 30 million barrels a day down year on year. And it's not just the impact on production, which we're starting to see now with the OPEC Plus agreement, plus the economic cuts, if you like, that we're going to see in the US and elsewhere. We're also seeing that in the refining sector, as we say in the title of this chart, refining runs have plunged. And as you can see in the line that that we're showing here, we think that 2020 runs will fall by somewhere between the brown line and the pale blue line. We're not exactly sure yet, but we're certainly already starting to see from the data that refinery runs in the second quarter of 2020 we think down something like 17 million barrels a day year on year. Product stocks are still building, of course, because even though runs are down, because of the huge impact we've seen on global oil demand. But in the second half of 2020, we think we'll see some recovery in refinery activity, and that's shown, of course, on this chart. But possibly the refining activity will recover slower than the demand will recover. So we should start to see some improvement. We should see the refining sector continuing to be under stress to a large extent, because, of course, if refinery activity recovers at a faster rate than the demand recovers, then obviously they will remain under stress. But diesel demand, as we saw in the product chart I showed a little bit early on, reflecting global demand, diesel has fared rather better, or slightly better perhaps, than gasoline, and certainly significantly better than jet fuel demand. So in the second half of the year, if we do see some improvement in the economy, the freight sector starts to pick up, that should provide some support for diesel. And of course, even in the maritime sector, marine gas oil demand may well pick up. So we should see some support for demand in the second half of the year, and that will, of course, be a major support for margins, as I hope you can see on the actually quite complex chart on the right-hand side. Diesel is going to be the main support for margins as we it already is, of course, and as we move through the rest of 2020. Now, another major issue which is occupying a lot of airtime at the moment is this issue of storage capacity. And one of the factors, or a principal factor behind the negative prices we saw in the United States at the beginning of this week was the fact that the storage facility at Cushing in Oklahoma, which is the physical delivery point for the settlement of the NYMEX contract, is filling up very rapidly, and it's believed that in the next couple of weeks or so, 3 weeks or so, that the capacity at the Cushing facility could become fully utilized. Indeed, it's widely thought that it's already fully booked. So people looking to store crude there who do not already have capacity booked may find it difficult to gain access. But around the world, we've attempted to come up with an idea of the availability of crude storage capacity. And there is no such thing as a comprehensive database that you can just go to and look up and find the capacity numbers for every country in the world. We've done a lot of work taking data for countries where there is transparency, and we do have significant knowledge of the situation. For other parts of the world, like Russia, for example, where nominally the storage capacity is a state secret, we've attempted to come up with our own estimates. And this is a relatively crude piece of work because, of course, the conditions vary significantly in various countries. There are countries where there is spare capacity, but it's not likely to be immediately accessible for some surplus crude because of the not necessarily will there be the availability of ships to move the crude to where there is capacity, or indeed there could be issues over pipeline access to storage facilities. But what we have done is make an assumption based on a normal operational capacity figure of 80% or so, plus or minus 5%, and then taken our implied builds for the month based on the supply-demand balance, which we'll show you in a second. And that leads us to conclude that, broadly speaking, we use the phrase mid-year at the bottom of this slide, where nominally on paper, operational capacity is likely to run up against its limits. It could be a little sooner. We can't be very precise about this, but the point we're trying to make is that certainly as far as the operational capacity is concerned, we are likely to be running up against the limit in most places in the world, most major markets in the world, in the next few weeks to a month or so. Just very quickly on a couple of stocks, charts on stocks before we get to the final slide. United States crude stocks, the complete numbers for March, built by over 1 million barrels per day. And the more recent data looking into April shows that level of build has continued. So we're seeing already very, very large increases in stocks in the United States as a whole. And in the mid-continent, the PAD2 region, which takes a lot of crude from Canada and elsewhere, there's a big build in that particular region. So stocks are building there. Floating storage doesn't often get too much interest because it's a relatively quiet sector of the market. But with a lot of on-land storage filling up and a lot of crude on the water moving to markets that might not wish to take it, we're starting to see an increase in the volumes of crude which are known to be stored on ships. And that has picked up considerably in the last month or so. And the new data, which we'll add to this chart in due course, shows that continuing. So unsold barrels finding a home at sea, as we say, we think that that went up in March by about 0.7 million barrels per day. And that will continue to eat into the available shipping capacity. But again, as with physical on-land storage capacity, there's a lot of thought that the ships which are nominally available may well have already been booked, and it may well not be possible to gain access to floating capacity if you haven't already reserved it. Again, we need more data to be entirely clear on that. Chinese stocks. China is very interesting in that this is an implied stock change number because there isn't an official stock figure as such. And we've seen considerable builds in January and February and into March in China, partly because refinery activity has fallen very sharply in response to the demand crisis that we saw earlier in the year in China. But also stocks are being built up because prices are very low. The Chinese authorities are taking advantage of lower prices to build up strategic stocks. Again, there isn't full transparency in terms of the difference between commercial and strategic stocks, but there is no doubt whatsoever that Chinese crude imports have been very high in this early part of the year, and we think into March they've gone up even higher. So the implied stock changes, which we're going to look at in a second, those implied stock changes are starting to be filled in and justified by actual stock changes around the world. And this is the chart that I've referred to already 2 or 3 times in the presentation, and it's the final substantive slide in this pack. What this chart represents is the implied stock build based on the difference between our estimates for global oil demand and our estimate for global oil production. Now, even back in 2019, we were seeing for the year as a whole significant stock builds. They look very puny on this current slide because of what we're seeing in 2020, but we were already seeing stocks building in 2019. In the first quarter of 2020, based on our current estimates of supply and demand, the implied build is about 7 million barrels per day. But it's this current quarter, which takes in Black April, as the IEA called it, and a not much lighter May. We're seeing in the second quarter, the current quarter of 2020, an implied stock build of over 17 million barrels per day. Now, what's interesting here is that on the assumption that there is not a second wave of the coronavirus, and on the assumption that the containment and lockdown measures that we are all living under, on the assumption that those are eased and the demand performance starts to pick up, and on the assumption that there are significant production cutbacks by the OPEC plus countries as well as other non-OPEC countries, we start to see the market begin the process of rebalancing. So in the third quarter, we flipped from a surplus of supply to a nominal deficit where demand actually exceeds supply. But of course, such are the expected increases in stocks in this first half of 2020 that the improvement we see in the second half is just the start. And that, of course, again, is made on the assumption that we are getting a demand recovery in the second half of 2020, which remains an open question. So I'll end at this point with just one last slide, which I just added at the last second this morning. And I just labeled the signal of trouble ahead. The IEA is going to publish in the fairly near future its World Energy Investment Outlook, which looks at all energy sources, not just oil, and some preliminary numbers, which these are not final or official as such yet, but it's an indication based on the research that we've been doing that we think in reaction to lower prices and in reaction to the statements we've read from the major companies, that upstream investment could fall by over 30% this year. You might think, of course, with the glut we see in the market that this isn't particularly an issue, but if there is a strong recovery from the coronavirus crisis, it could be maybe 3, 4 years, 5 years from now, that the fall off in investment that we're currently seeing might come back to bite us, but we'll have to wait a little longer before we can see that that's the case. I'll end at that point, and I'm very happy to take any questions or observations in due course. And I hope I've left some room for our dear friend Antonio from Repsol. Thank you very much indeed.
Okay, Neil, thank you very much. We can clap, but this is, we can clapping to you for this outstanding presentation. And we are going to give the floor to Antonio. But your expectation is a V recovery in the demand, no? Maybe at the end we will, there are many people who are trying to ask you about this, no?
We'll see, yeah.
We'll see, we'll see. I think, Antonio, it's okay, you can...
Yes, are you hearing me?
Yeah, I'm hearing you, but we are seeing all your slides together, like a puzzle.
This is good, because then you will get confused. Okay, so thank you.
Are you ready? Are you ready for this?
Yeah.
Okay, go ahead.
Thank you for the invitation. Thank you for having Neil on board, because I think what I'm going to say is just to complement what he has already said. I'm always very fan of what they are publishing, and this time the April monthly, I think it's very good, and for the first time they are giving us not only demand but also their outlook on supply, which means it gives us a better knowledge or a better understanding of the challenges of shortage of storing barrels. So, with all this being said, I just want to introduce 2 or 3 ideas about the global economy and the challenge to really know what is going to happen in terms of everything is going to depend on the shock on demand, but this is particularly for economies is a supply shock which have demand consequences. So we can see the GDP coming back, but at the same time, mobility can be affected in a way that we never thought before. So the first idea is this is something which can be compared only with war and with pandemics. And this is just a calculation of an academic paper saying that in the case of the flu, the last time we have a GDP loss of 6%, which is particularly high, but as you can see, it's compared pretty well with war. Most people tend to believe that the 1919 was the main number of casualties were caused by the war, but many of them were caused by the
Valentina.
Do you follow me? So the other idea is that if this is a special way of crisis, what the consensual view is on the economy. And the consensual view on the economy, this is a graph from the IMF. It's quite, I would say, particularly interesting and particularly challenging. Firstly, you have a blue line, and the blue line is the GDP in levels, with the big drop in the GDP being concentrated on the second quarter. And you can see that to come back where we were in 2019, we have to wait till the end of 21st. So what we are saying, this is a recovery, but this is a recovery that is going to take time, and it's not a V recovery. Which is funny is when you look at what is the expected evolution of the GDP in emerging countries, as you can see, you have something like a new, but the level of the GDP for emerging countries is about what it was in the fourth quarter of last year, in the third or fourth quarter of this year. So it's just an V recovery in which you have a big shock. Why this is the IMF view? Well, mainly because people are thinking that China is about 25, even 30% in what we call purchasing parity of the global GDP, and people think that China is going to go from 6 to, we know now that is 0 in the first quarter, and then it's going to recover very fast. So let's challenge this view with the numbers that Neil has introduced in such a, well, in my view, brilliant presentation regarding demand. I'm just challenging from top to down the evolution of non-OECD demand and the emerging countries' GDP. The slides are in Spanish. Most of the audience are Spaniards, but they're very, very easy to follow because it's just how you see that the growing GDP, sorry, the falling GDP has its counterpart in the falling non-OECD demand. Which I'm going to show you that the shape of the numbers when you compare OECD demand as pictured by Neil in the monthly and the GDP of advanced countries, you have at the end a big difference. What you see is that they are supposing as GDP recover, OECD demand recover, and you can see in terms of level that it goes up with the level of the GDP, while in the emerging countries, it's a little bit lower. Well, this has to be, I would say, checked with one reality. The reality is, for the time being, and this is just the new COVID or coronavirus cases updated yesterday, as you can see, most of the cases are in Europe, are in North America. They are growing a little bit in Oceania and, well, a little bit in Africa. But as you can see, we are more or less stabilizing the number of new cases, 80% on a daily basis, but we don't see a still big increase in new cases in a lot of countries in the emerging world. So my idea is that although they don't have the health system that other system, the advanced countries, they have already taken measures and they are confined, as Neil said. So the question is, could it be that these countries are going to be confined for more time because they are at risk? They don't have health system that will allow them to fight. What they have to do is mainly just to be confined as the best option. So I'm trying to convince you that the question of mobility is going to be affected. I mean, we saw the figures that Neil presented, but this just to complement what he said. This is the change in mobility in big cities. And what you have here is you have the mobility 1 year, or the average mobility 1 year before, and the mobility now. This is quite easy to get. This you can get it from Google. What you can see is New Delhi. So you don't have such a big increase in New Delhi cases for coronavirus, but still the mobility is very limited. And then you have Madrid is 90%, so it's only 10% of mobility. Demand in Spain in terms of gasoline, it's minus, or in percentage, it's only 20% of what it was before the crisis. But you can do this with many big cities, and what you see is that the amount of confinement in terms of mobility is higher. We are not talking about a change in terms of mobility of, I would say, 30%. We are saying that mobility went down like 60, 70%, which could have, for an analyst, say, okay, 29 barrels in April, as Neil said, is for me, is perfect. But someone could say, okay, it could be even 34, 35, and you can panic because you don't know if there will be enough storage. Because my view of what's going on is just about hitting the storage wall and what happens when there is not enough storage. But for the time being, let me continue with things which are focused on, we don't know how long it's going to be the containment, but mobility is going to be affected. So this is again to complement what Neil said. As you can see, 65 million barrels per day are already, or are mainly mobility. So it's about what are your assumptions about we are going to recover from mobility that will give you an idea of how big is going to be this crisis. I don't know if you have seen this graph before. If you haven't seen it, this is great because it took us a lot of time to find it, and we use it as a forecast scenario. Well, when you look at coronavirus, you look at the lockdown in Wuhan, for example, and then you say, or you've been said, China is recovering very fast. And this is not true. Some parts of China are recovering very fast, but some parts of China, we had a number of casualties because of the coronavirus, less than 80 people. So when you look at Shanghai, the number of casualties, it was 80 people. You can see that still Shanghai is 10% below its GDP a year ago. This is all with big data, but it works. We were checking the rootness of the forecast. What I'm saying is, in China, 3 months after, what you have is Peking is about 60%, and then in Wuhan, which is the most comparable state with what is going on in Europe, it's still 40%. So in a sense, if you look at 1 quarter being between 20 and 40%, what we are saying is it could be that the effect on demand could be even higher than what we have in mind. Anyhow, coming back to the consensus, this is a view of the forecast by Neil, and just a comparison of what he just already said, that this is huge compared to what we saw during 2008, 2009. So in a quarter, 23.1 less million barrels per day. In April, as he said, 29. And this is what he mentioned, and I always use it as a guide. No? Normally, I have to put my own estimation about OPEC production. This time, I took it directly from you, Neil. And what you can see is we are talking about 18 million barrels per day of excess production that has to be put it any place. Last crisis, 2008, 2009, we have contango, and nobody was thinking about problem of storage. So when you have, when you have a lot of contango, you have 2 types of demand. You have consumption demand and demand for storage. And demand for storage was huge, and that was the bridge for having prices moving up. So 2 or 3 graphs just to show the magnitude of the crisis. You have an overhang. This overhang was suspected, but in the US, nobody was expecting such a big overhang at the end of March. These are the data from the Energy Information Administration. And as you can see, and this is what we are trying to assess, is are we at the bottom? So we are saying is 50% decrease in gasoline demand in the US. For how long? Because this is huge. We're talking in a country where the car is like the second house. And as you can see, the fall was, it took place in 2 or 3 weeks. And actually, we believe that it's 50% fall, and this is going to continue. For how long? This is a big question. Why so? Because the big question and the negative prices that we have seen took place in the WTI and not in the Brent, so it was an American issue that I want to try to deal. Before going exactly to the US situation, this is a graph which summarizes what I'm saying. No, it's to the point that, okay, I don't know how the total amount of storage is being full, but but the question is, in North America, it's about 80% when we're talking about last week. So firstly, we have a logistic problem. Secondly, we can find or not, because the cut by OPEC and other countries are coming, but still, as you can see, there is a lot of problem if you face a big increase in oil because of the fall in demand. Well, this is the same with the same idea, with an idea in which you can see, as Neil was saying, that when you see a lot of storage at the sea or just the inventories at the sea, that means 2 things. One, there's a lot of oil not being delivered, and also that you think that for logistical problems, you are putting this into the sea. What happened in the US is that the price formation takes place in Cushing. Cushing is a hub of pipeline, and it's landlocked. So they have a problem. And you can see this in the US when you see the the crude inventory, you can see that they're going up. They are practically in a path that will imply that by the end of May, they will not have enough storage. They can put it into the sea, as we were saying before. But the question is that for pricing of WTI, the inventories level that we have to see is Cushing. And if you look at this, Cushing inventories being filling by approximately 5 million barrels per week, which means we are now about 60. And if it's continue like this, normally people tend to believe that we are talking about 65. The maximum amount was 60. Well, it can be hit the wall of the storage in a couple of weeks or in 3 weeks if there is no change. Okay, that was the beginning of the problem. And the beginning of the problem was, okay, there's not storage capacity, so demand for storage disappear. But the second question is, and you can see here a graph which is quite similar, and I haven't seen it, but the colors are the same, in which you have the negative price in WTI. The negative price in WTI happens from 0 to minus 40 in, I don't think, more than an hour and a half. And what happened has to do with two things. First things, some of the barrels in the future country has to be delivered, and the point of delivery is Cushing. So if you don't have a storage capacity, then you are lost. You try to sell it, but the only one that is going to buy it is the one that has storage. If you made the calculations, those barrels has to be delivered in May, and you made a calculation as I showed you before, and you look at this graph, you say, oh, there's no storage for May. So you have to pay me because I'm going to get some of my storage and I will move through rail or I will move through whatever mean I have, but this is why it's costly. So we can understand that this will imply that prices in the day of the liquidation of the contract, when you have to either settle the contract by difference or delivering the contract, will go down. But why it went down so negatively, as is the case from time to time in electricity, and that has to do with something called the money manager investment. You know, since the OPEP agreement, people thought that on the one hand, there is an argument or a narrative by which as soon as we have the cuts, price will move up. It is not enough the cuts that they have already done, but they believe that if I want to invest in crude oil, I need to put some money into the contract. And what you have here is at the end in the red square, you can see in the light blue, the managed money future and option ratio. And what you see here is for the first time, we were increasing the ratio, and at the same time, the oil price was going down. These data are before April 20, when the negative prices happened. My idea, and some of the people analyzing the markets, is that traders, because they need to move the contract when they are investing in this type of products, and I'm going to show you in a moment, you invest in the front month, when the front month expires, you move your position to the second month. So you continue having a position in the future markets. Normally, what you do this roll on a week before the expiry of the contract. Because the prices were very low, traders decided to wait and they say, okay, let's see if the price recover because we have a OPEP agreement, let's see. And they wait till the end, and they wait till the end. And when they wait till the end, they show one more week of data in the stocks of Cushing, and they show that in the physical market, the price was 0, and they were forced to sell their position because they need to sell that position, they don't have physical, and they move prices down to 90, 35, 36 was 7, sorry, which was the closing, and minus 44 for a minute or 2 minutes. What is happening in the WTI is as I'm telling you, the complex effect of physical and financial markets. This is what is called the UL, the use of total asset under management, and these are ways to invest in oil through exchange trade funds. And what they do is they take a position, they roll their position. As you can see, they increased dramatically in 2020 as a way of passive investment in crude oil, as you can invest in an index in a stock exchange. this was part of the problem, and this part of the problem has disappeared because they were cut, they had so pain that for the next contract, we see June, probably we could experience, if demand is still very low, problems in terms there is not enough storage capacity, but what we don't expect is to have those guys doing the rolling at the same time. They will do it, or they will do something differently, but they are not going to wait till the WTI contract will expire on the 21st of May. So this is not going to happen again in terms of such a negative prices. What happened to the Brent afterwards on the 21st and 22nd of April was a little bit different, but it was quite impressive also because it went down to $18 per barrel. Most people has been arguing that the floor for the Brent price is 20 because we have, firstly, the OPEC cuts will be implemented in May, and then we have, as I told you, the contango curve, which now is not so positive, but you have a contango, you storage the oil, and then you put it to the future. The question was that what the Brent people saw was if at the expiry of the contract, you have physical trader moving with oil and there's no storage, the price is going to come down. So if you have any kind of financial investor doing the same because they have to move forward, they have to run, they are not going to wait. The expiry of the contract in the case of Brent is at the end of the month, so next week. So what has happened is they did their rolling this week, and this took down the price of Brent below 18 during Asian times. We are trying to believe that they are hedge funds moving their position. But this time, what they did is, I'm not moving my position from June to July. This market is open to panicking because of lack of storage. So I'm going to move it to December. So if you look at the numbers, they tend to believe that by December, the situation will be much better in terms of storage capacity. And then you can see this in the graph. This graph is just the open interest in the most traded options in Brent and the month of expiry. I don't know because I cannot use the pointer. As far as I know, the Energy Club do not provide the presenters with a pointer. It has to be introduced next time because it's very useful. But I'm very good at pointing you with a PowerPoint. So look at December 20. That is the expiry of the end of the year. You can see how many calls compare with puts being cut, call being buying the contracts. So a lot of people is buying into December and they move from June and they move from July. As you can see in July, there are more people with puts than with the call. So what I'm saying is there are two differences between the Brent and the WTI. The WTI is landlocked. It's quite difficult to move oil from there, and there is a lot of physical delivery, and also a lot of ETF are in this contract, while you have professional hedge fund in the Brent, and there is a lot of space. I mean, you can move to see all of the production. Then we have many differences in the way Brent prices is formed, but I think the panic situation that we saw last month, can be reproduced in terms of the physical situation of lack of storage. But I don't expect the same type of volatility or the same type of downward prices, because the financial agents are on the one hand suffering the pain of being long when the contract expires, and at the same time they are trying to get a view on the market by staying out of the next month. Well, imagine that now we have to say something about the future. We have talked about demand, we have talked about the dynamics of pandemia, the dynamics of mobility. Let's talk about the game theory and the Russian and Saudi Arabia case. My view is that in terms of net creditor status, Saudi Arabia has a better position than Russia, although Russia is strong in terms of natural resources. But that means that Saudi Arabia, through the price war, would have survived quite comfortable for 1 year or a couple of years. Then production elsewhere will come down and they will increase their market share. So even for a game theory, Saudi Arabia position makes sense. What doesn't make any sense is what we have now. when a price with a price of 20 or 30, the amount of deficit and the amount of problems in those countries will, and this is what I think, will force them to realize that they need to have another run of cuts. Well, I'm not going to dwell on this because as you can see, in 21, 26, what we have done is put an average price, we put it into a macro structural model, and what we have is Saudi Arabia will have a deficit of 11%. I don't think this is going to happen, and if it's happening, it's a problem.
Antonio, vamos terminando, tenemos preguntas.
We're finishing. The only idea is, I believe, I don't know what Neil thinks, that there is an incentive, an economic incentive for cutting production in the OPEC. In the non-OPEC, there are two things that I want to say. First, in the US, and I will end by that. I think it's going to take place because the number of rigs is coming down very dramatically. Oklahoma is changing the law, so I think it's going to come down faster than it's now in the consensual view, which is Neil's view. What I want to show you is Canada. This is the Canada production. Most of Canada production is a Canadian province, I will say, issue in the terms that for cutting production in Canada, the only thing that we need is the Alberta province cutting production. My idea is that we're going to see cutting in Canada, and then we will see some reduction in Norway, and a big change in US. So this is the last. I'm gonna show you something with a dynamics approach, and I want to say that for the first time, this dynamic approach is the same when I use Neil data. So I'm glad the way you draw the change in US shale production. What I do, Neil, is I have the US oil recount, and then I have the oil production lag 12 months, and then I put your actual number. What Neil is saying is, okay, this is going to happen, minus 300 barrel in shale. And so it's okay, I'm really okay. The only question is, instead of 12 months, if they cut it production faster, we can have this. So what I'm saying is, the dynamics of the supply in the US are practically automatic. So they are working right now. To what extent the demand consideration, a lack of mobility, problems in emerging countries which are going to be confined more than we think, can be balanced by the fact that there's a lot of incentive for OPEC to cut, and also for Canada, which is they have done in the past. And then what we have is not only legal question in the US, but the fact that normally shale is going to come down faster than we think. All in all, I think we're going through difficult times, not only in terms of health, in terms of pandemia, and in terms of economy, but in terms of balance the market. But the drivers are there, and they should be balanced, and I fully agree with the view that Neil just drew in its presentation. Thank you very much, and I pass you the floor.
Thank you very much, Antonio. It's a pleasure having both of you. Some comments about this, Neil, the last question from Antonio, or maybe we are going to the people who are asking questions. Open your mute. You're mute.
No, it's okay, I think.
No, he's mute.
Okay.
It's okay.
Go ahead.
Okay, we have a couple of questions. Some of them you have already answered, but maybe you can go deeper into them. One of them has to do with Brent prices, and if you think that what's happened with WTI prices will happen the same with Brent prices. That's one question. And another question is, what kind of impact can the negative WTI prices, can they have in the fracking industry and the financial industry? Are we going to see bankruptcies around, or you think we won't? That's the first group of questions there.
Okay, I'll try and be brief.
Stella.
I think we sort of covered this, and Antonio certainly covered it very well in his contribution. As far as the Brent price is concerned, Brent will reflect the fundamental pressures of the surplus of supply over demand in the next few weeks and possibly longer. There's no question of that. and we should see, depending on the demand recovering, depending on the success.
Cela, déjala silla.
We might see Brent stabilize, but I think it's likely to remain under pressure. The structure of the market in Brent is different from WTI, with the physical settlement at the end of each month. It isn't the same in Brent. Just on fracking very quickly, will there be bankruptcies? Well, there's already been some Chapter 11 filings in the United States. Activity is already, drilling activity has already fallen very sharply. I didn't put up a slide on that today perhaps to save time, but drilling activity has fallen very sharply already. There have already been some Chapter 11 filings, and it is likely, if the prices remain as low as this, that there are going to be further cutbacks. That may include further bankruptcies. We'll wait and see. But as far as financing, the finance is concerned, there are a lot of companies. There are a lot of companies operating in the shale sector. They vary in size enormously. The majors, Exxon, Chevron, Conoco, they obviously have deeper pockets and the ability to withstand a downturn rather better than others. But it is possible some of the independent companies that are in perhaps a slightly better state than the smaller ones will attempt to ride out the crisis as best they can, because the smaller, weaker companies may exit the industry because they run out of money, and by doing so they leave behind a better playing field for the stronger independents and of course the major companies. But we'll have to wait and see. We would expect that with prices for WTI having fallen to 16 or 17, whatever it is today now, that the pace of production cutbacks, we assume, will accelerate.
Thanks, Neil. Antonio, they're asking you about your, say, forecast on the storage landscape. Will new infrastructures be built? What will happen if there's no more storage capacity? That's the second group of questions.
Well, I think the first new storage capacity is being built, but in my view, the best storage capacity is for the oil crude to remain on its fields. So what we should see is that if we check that there is not enough storage capacity, on the one hand, we are going to see places that are going to be used as storage, like railways, wagons, and caves that have been used before. But actually, I tend to believe that the market should react by shooting in production faster than we are thinking. It didn't happen in the last crisis, 28, 29, because never we were facing the limits of the storage. When you look at the market reaction last 2 days, what I think they're saying is, on the one hand, well, I'm moving my financial position to December, but on the other hand, they are just checking how much storage is there, and if we are going to go to the brink. I mean, if the storage capacity is going to be overwhelmed. My idea is, I think there are a lot of logistic problems, and this is why we should wait 2 or 3 more weeks to really have an idea of what could happen.
That's just adding to that. Antonio's made very, very good points there. What we need to remember here, it's not just a question of adding more tanks where there is already capacity, say at Cushing or anywhere else, because you still have to get the crude to the tanks, and that implies adding pipeline capacity. Where oil arrives by ship, you have to have the capacity for ships to offload the crude, and it has to go into pipelines, and then it has to go to storage. So it's not just storage. There's a lot of infrastructure which is required to get the oil to the storage facilities, and that shouldn't be underestimated.
Okay. There's another group of questions concerning refining. I know, Neil, you've talked a little bit about this, but they want to know, Antonio, your view on national refinery production in case this situation spreads out in time. So how will the current situation affect national refineries in Spain?
The national refineries in Spain?
I mean, refineries in Spain.
I mean, we should wait for demand to come, and when demand to come, we will see the cracking going up. If you look at the cracking right now, the cracking for our refineries are not that bad because oil price come down, and then even though the demand is not there, still people believe, okay, I can store those products, and if there is storage capacity, I will run my refinery. But on average, what we have seen is that refineries in the US are 12 million through output compared to 16, 17 that are the average last year. So they were forced to decrease its level of activity. And in Spain it would happen the same, which with caveats. And we were mainly an importing country before the last crisis, and afterwards with the increase in refining investment, especially by Repsol, what we have is that we are exporting products. And for the time being, what we have to check is if we have a storage, and then if we have customers, or if we can move, if we have ship to move that. And at the end, it's just a question of how long is going to stay this demand so low. For example, in Spain, I've been checking, and as we have nailed a lockdown for a while, and then we have an increased lockdown that lasted 1 week. So we checked the consumption, and gasoline consumption went down to only 5% because all people have their tankers full, and some of them, they use it. So when you recover again to the normal lockdown, now gasoline consumption is 80, 85. But for gas oil consumption, it's still 65 after this increase or special lockdown, because people are using internet for buying things, and also because there's increase in the economic activity through moving goods, for example, for construction, things like that. To the extent that this continued to the month of May, these small recoveries, I have the idea that if there is still the cracking being enough for continue producing the refineries, it will continue. But my idea that this is not going to continue because we are going to hit storage capacity, and somehow we are not going to be able to what we call sell this into the market. But this market is very, I always say, Darwinian, which I mean is some companies will survive and some companies will cut production sooner, which means that you can put like a ranking of companies that can delay, and then they can get the market of others. So you can, some of those refineries, it is quite complicated about which is complex, which is not complex, which type of slate you're using, things like that. Some companies, some refining companies will reduce its production before than others. And in Europe, it's already taking place. But Neil is an expert.
Go ahead. Just on the wider refining issue, before the coronavirus crisis struck, we published a 5-year oil market outlook in early March, and we had anticipated in that report that the net change in global refining capacity, it would increase by just over 6 million barrels a day, about 6.2 million barrels a day, something like that, net capacity growth to 2025. In that same period, the demand for refined oil products was expected to go up by only 4.4 million barrels a day. So before the coronavirus crisis, we were still expecting there to be overcapacity in the sector. Now, in today's market, obviously we can't be exactly sure about the pace of recovery of demand in 2020 and 2021, but it's quite likely that in 2025, oil demand could well be still at the level that we saw in 2019. We can't be exactly sure. Meanwhile, most of the net capacity growth in the refining sector will probably still have gone ahead. Maybe not all of it, but most of it will still have gone ahead. And so the refining sector as a whole, particularly in the Atlantic basin as opposed to Asia, will be faced with overcapacity, and that is a major challenge for them.
Okay. Maybe, Arcadio, we have a couple of questions dealing with clean energy transition and how the drop on oil prices can affect clean energy transition. Maybe we can finish there.
You want me to pick that up? Okay. I'm not the best person to talk about clean energy transition, having spent nearly 40 years in oil, but obviously we do have views on this, and the IEA is doing a lot of work right now, my colleagues elsewhere in the agency, on trying to understand what the impact of the current crisis is. And the IEA is making a very powerful case that investments in clean energy as part of economic recovery packages agreed by governments could play a very important part in that economic recovery. And we're hoping to encourage governments to place investments in clean energy, give that a high priority in their recovery programs. At the moment, of course, the energy companies across the board are obviously in a very, very weak environment as far as they're concerned, not just in oil itself. And of course, it is these companies who will be providing a large part of the investment to move the energy transition along. So clearly there must be some doubt of their ability to fund investments to the level that we might have expected before the crisis, but we don't yet know the full impact. But the IEA does hope that the crisis that we're currently seeing now might be an opportunity to bring together the need to generate economic growth again, and at the same time further the clean energy transition. And we hope that turns out to be the case.
Mm-hmm. Antonio, you want to add up something to that?
Well, as you know, Repsol committed itself to reduce and to be neutral by 2050. So we are committed to the transition. The question is, globally speaking, what are the implications of this oil crisis? This oil crisis doesn't come alone. It also is an economic crisis which affects also gas prices. So most of the transitioning is coming through renewables in the electricity sector, although it's always transportation, it's always industry. And if we look at what's going on, there are two main lines of thought. One line of thought is what the agency and most of us think that, well, this is an opportunity because in the recovery we will need to do a lot of investment, so let's have green investments. The other is, this is a problem for the transition. Firstly, because gas prices are very low, CO2 prices because demand has fallen and probably the demand level is going to stay below what it was in 2 years ago for a while. Then CO2 is a cost, and the question of cost when the price of gas is very low, it's quite relevant. So people will say, okay, why I'm adding cost in a situation of economic crisis? So I should go for the cheapest solution. And the other thing is about mobility. So mobility and social distancing will imply in some people's mind that instead of public transportation, we are coming to the car, to the private car. And if these are the case, private car and private transportation, then probably that will, in a sense, delay the transition. While in the China case, they are selling more and more cars, the Chinese has already decided not to cut, as it was the case, the subsidies for the electrical vehicle. And then in terms of profitability, for the margin of this renewable energy when oil price, I've been always defending that high oil prices are the best for renewables because then make all the renewable energy sources competitive. So going forward, in a background of lower oil prices and lower gas prices and economic crisis, the other line of thought is, well, the transition is going to be delayed. But I have not a clear idea of what's going to happen, but I just want to point it out that there are two lines of thought. This will increase the speed of transitioning, and then we said it's going to be a slowdown in the transition that we're saying. In any case, the amount of CO2 produced is going to be reduced. No question about that.
Thanks, Antonio. Okay, Arcadio.
Okay, do you like to add something more, Neil or Antonio? Something more to this for finishing this? Because we are at the end.
No, I have nothing to add. The people who have joined in the call today, they're very welcome to have a copy of the slides if the club wishes to.
Sure. And we expect you will be back here in June, as you told us, with this oil report in general. No?
Well, we're hoping to. We haven't committed to this formally as yet, but we published a 5-year outlook in March, and of course that's already out of date because events have moved so fast. So we're hoping to come up with a revised view, but that's dependent on us being able to understand what's happening this year and what the recovery will be like next year. And if we have enough data and enough insight to provide an outlook for 5 years, we will do it. And if it does come out in June, we'll be delighted to come. Hopefully, we'll be able to come to Madrid in person.
I hope you will come in person here in June or in July, whatever you want.
Whenever it works out, yeah, sure. Let's hope so. Thank you.
Okay. Thank you very much of both of us, Neil, Antonio. Antonio, we see each more times, and all of you, thank you very much of all of you for coming here. We have had 200 to 220 people here in this conversation. Is a topic very interesting for all of us, and thank you all. You'll be doing, I hope you will be doing well, and we are going to organize more of this, maybe in the CO2 markets or something about the USA market too. Okay, thank you very much of all of us, and be safe, no? Cuidaros, no?
Thank
okay.
you.
Neil, thank you. Antonio?
Thank you very much.
Applauding. All of you.
Take care, Neil.
Hold on a second.
Thank you very much.